Hello, welcome to the Private Capital Management Quarterly Market Commentary. Today we're going to be talking about the fourth quarter of 2022 and really the entire year, looking at performance and factors that influence the markets. My name is Kevin McCulley. I'm a senior advisor at the firm. Let's dive in. 2022 was really a challenging year. There are a lot of events to follow in 2022. Cryptocurrencies had a really challenging year. High and rising interest rates, high and rising inflation, slowing global economy, supply chain recovering, and just a very strong consumer and labor market continuing to spend and really put the foot on the gas from a demand standpoint. One of the big sort of market-moving headlines, again, was related to interest rates and rates going up and how that's going to affect certain types of investments. Notably, when you look at a lot of the stocks that did really well during the pandemic, a lot of the stay-at-home pandemic darling stocks were growth stocks. A lot of them were software related and they were trading at really high multiples. So when rates go up, obviously the discount rate goes up, the value is going to go down, and so a lot of these stocks were trading at valuations that made no sense. They were very similar to dot-com era valuations. We had a bit of a repricing as far as growth stocks are concerned. In many instances, the drawdown was worse than what we saw in the dot-com boom and bust. So a lot of the high flyers from 2020, 2021 were down 60, 70, 80% this year. Fortunately, they were considered small cap growth stocks. They weren't widely owned, so as far as an overall portfolio impact, it was pretty minimal, but certainly for those who held the stocks, it was painful. In the first quarter and the second quarter of this year, we actually saw an economic contraction, albeit a small one. That isn't technically the definition of a recession, but that's how a lot of people will baseline, expecting a recession. To this day, we're not technically in a recession. Fixed income was really the story of the year, being challenged by rising interest rates. Investment grade bonds delivered the worst annual return in modern history. Put it in perspective, we've never had a year in the last 150 years where stocks and bonds both declined by more than 10%. So really the story in 2022 was you had the low risk part of the portfolio, being bonds, not providing any downside protection to the higher risk or equities part of the portfolio. And that was nearly entirely driven by the fact that the Fed had to raise interest rates to combat inflation. The price of a bond is impacted by a change in interest rates, especially for a fixed rate bond. So as rates go up, the value of the bonds go down. Looking at a style perspective, value stocks did considerably better than growth, which bucked the trend, say, over the last 10 years, where mega cap growth stocks had been compounding at more than double the rate of return that you saw from value stocks. And again, I think a big part of that was just due to very aggressive Fed raising interest rates, perhaps inducing a recession, tightening to that point. Labor was in very high demand. We saw a lot of wage gains last year, and in order to get lured back, say for hospitality, leisure industries, they were demanding pay increases. And the unemployment rate actually is sitting at near 50-year low in the mid 3.5 range. If we see the unemployment rate going up drastically, that's a very negative sign. And so the fact that the unemployment rate has been steadily declining, labor demand in general is still very strong. So one thing a lot of economists will look at essentially is the rate of change of the unemployment rate over a baseline. If you do see a quick increase in that rate of change, that can be a recession signal. Other parts of the economy might be slowing down, but labor continues to be very strong and is not signaling a recession at all. The Federal Reserve aggressively raised interest rates this year. You've seen inflation hit rates that we haven't seen for about 40 years, and the policy reaction was to raise rates to try to slow down demand, and of course with it bring inflation back down to more reasonable long-term target levels. The US dollar has been very strong relative to foreign currencies, and largely was driven by the Fed raising rates aggressively and telegraphing to the world that they were going to continue raising rates until the Fed tamed inflation. Increased treasury rates made the dollar more attractive as well, and we saw the dollar appreciate significantly relative to pretty much every foreign currency out there. That trend reversed somewhat early in the fourth quarter. It was due to a variety of reasons. Could have been the fact that the dollar was just simply overvalued on a purchasing power parity basis, but I think it was also related to central bank action from some of the other central banks around the world, like Bank of Japan and the ECB, coming out saying, hey, we're hawkish too, we're going to raise rates too to tame inflation. And then you saw, of course, a depreciation in the dollar relative to other currencies. I think the narrative has changed as we have ended the year, and that from where we stand, we think the Fed's more likely to pause on monetary policy and not pivot, notably because it takes time for interest rate hikes to affect the market. Things like interest rates around, say, mortgage rates might move instantaneously, but borrowing decisions for a company or capital expenditure decisions for a company takes some time. 6 months to 2 years is really when that full effect will take hold. And so I think the Fed's #1 priority here is to not repeat a mistake the last bout of high inflation, which was to assume that inflation was under control. And of course, we saw a resurgence in uncontrolled inflation. So I think at this point, the Fed's going to really focus on maintaining policy rate once they do get to their quote-unquote terminal rate, and see how it plays out in Main Street and not just on Wall Street. To recap, 2022 was a challenging year, but we're looking forward, cautiously optimistic. Of course, there's a lot of unknowns about the economy and how it will persevere in 2023, but we do expect much better returns for diversified portfolios going forward over longer periods of time. Now, where we stand today, I think January 2023 is a whole different picture than, say, a year ago, because you look at a 1-year treasury yielding around 4.5%, then all of a sudden the expected returns for bonds look quite a bit better. The 10-year treasury was less than 1%. So if our low risk part of our portfolio is now in the, call it 4.5 at the low end range for a rate of return, things start to look a lot better. It's still early in the cycle for a lot of the big research firms to update the numbers, but the trend we're seeing is that expected returns for long periods of time, say 10+ years, are going up, and in some cases going up by a lot. 2023 may not be a banner year for stocks, but it certainly is setting us up for better returns going forward than certainly where we were over the past couple of years. One positive note, you may have to think back to the spring of 2008, where you were earning 4% plus on your checking accounts, on your cash. We're back to an environment where you can actually earn that kind of rate of return again on cash, which is great. Certainly as the Fed continues to raise rates, we'll be earning much higher returns on our savings accounts. So that's a win for savers. One positive as we head into 2023 is that inflation really is coming down. For most readings, inflation peaked towards the end of the summer, early fall. And certain stickier components of inflation, like wages in the services economy, rent, some durable goods, continue to show stubbornly high inflation rates. But otherwise, we're seeing rather quick disinflation. We're past the great inflation scare of 2022, 2023, and we can get back to a better functioning economy. Thank you for watching. If you have any feedback, please let us know. My name is Kevin McCulley, again, Senior Advisor with Private Capital Management. We'll see you next quarter.